As his opening comment, Jeremy Grantham stated that the beauty of indexing is that you never miss an Amazon or Apple, and the disadvantage of indexing is that you never miss having a lot of overvalued stocks in one of the relatively uncommon bubbles such as what we have presently. So there's some good news and some negative news. If you can stomach the occasional 50-point drop, of course, certain fundamentals 30 years ago, the market is mildly comical from time to time, and it is justified by the consistent flow of dividends and earnings, but nevertheless occurs. It could take for you up to 20 years to get back into the game. If you were caught in 1929, everything works out okay, but you will not receive your money until 1955. If you are harmed in 1974, you will not receive your money until 1987. Then, after a month or two of having it back, you give it up again. And the same thing happened in the year 2000. By 2010, you were still losing money. So you have to be willing to ride it out, and some people believe they won't live long enough to take 10, 15, and 20% wipeouts. So, for those who feel brave and eager to try, he has always thought that avoiding part of the agony may be a good idea. They're simple because they're usually so extreme. It is similar to how you notice the Himalayas when you're in northern India. He means that when they come out of the plane and soar skyward, you can't miss them. From 1928 to 1929, there was a huge rally, so you can't ignore the price increase. Second, just to make things easy, the major bubbles have always tended to rise quicker and faster as they approach their peak, and it's also a distinguishing feature. Third, they have all been accompanied by large public displays of blatant insane conduct, where the headlines move from the financial page to the front page, where they become the first few sentences of the nightly news on the radio or television, and they discuss the market's new highs as well as what the bitcoins of the era have done. When there is a bubble, it is best to have the bubble in a single targeted location in the year 2000. For example, it was US growth that slowed, not global growth, and real estate was extremely cheap, as in less than the cost of construction. The bonds were extremely inexpensive, and inflation-protected funds had just been released, yielding 4.2%. Even inside the market, the value stocks were not too bad, and the small stocks were not too bad, and the small value was actually low enough that after the S&P had gone down 50%. What you want to avoid is Japan's behavior in 1989. Japan experienced the biggest bubble in history, bigger than the South Sea bubble, in London real estate, and the ancient narrative is that the ground beneath the Empress Palace was worth more than the entire state of California. We must commend the Japanese for avoiding despair throughout the previous decade. However, that was the final decade in which Japan genuinely advanced. For the decade, they did not even go backward. When you accept that kind of wealth loss, you're in big trouble. The housing market had a perfect 3 sigmas 100-year outlier bubble that had been historically quite stable. So, to get to that level, it just had to increase by around 40% in 2 to 3 years, which it did. The stock market was not sensationally expensive, but it was a large overpriced bull market. It was not a bubble in and of itself, but the housing market was. As a result, you had lost a huge investment, and the housing industry as a whole is considerably riskier now that so many more people are involved in buying and selling homes. The middle class in particular earns a lot of money from housing but very little stock. According to Jim Grant, the bond market is the most overvalued it has ever been, and rates have never been lower in the history of mankind, going back some 4,000 years. We have the potential to become the US equity market's highest priced period. Although some may disagree, he claims that the vast majority of bubble experts now rank this year as second only to the historic year of the year 2000. And then there's real estate, which has been largely off-screen until just now. According to some databases, it's jumped 20% in the past year. Before the bubble, American homes typically sold for 3 times the average family's annual income. After the bursting of the bubble, prices rose to about 4.5 times income before falling back down. Furthermore, we have reached the multiple of family income seen in 1906 at the height of the real estate boom. Increasing asset prices hurt most individuals severely. When you have one, you can have a good time with it. Retirees with nothing to do but sell off their assets would benefit greatly from them. But it's a catastrophe for those who doesn't have it, and for society as a whole, because the yield on assets has decreased as their prices increased over the past quarter century. Even without including taxes, it only takes 48 years to amass 1/4 of the wealth that the ordinary person in the world at the turn of the 20th century would have had if they had invested their money at a rate of 6%. For those without financial security, this is a catastrophe. There is a very elementary mathematical argument here that no one seems to grasp, and that's the society as a whole is compounding considerably more slowly. It is a drag on the economy and the production of wealth, and making it appear as though everyone is getting wealthy. That's also true of the stock market. It is the same old stocks, by the way. Stock market bubbles pose a unique threat because investors can easily stretch the truth to justify a higher price. Looking back though, we don't see any kind of quantum leap in long-term earning power in the year 2000. Ultimately, it was all in good fun. He often boasts that profit margins are the economics discipline's most demonstrably mean-reverting series. In this case, it would be a terrible idea to spend more to have rising profit values. Crushed profit margins always rebound, therefore you should compensate for that. Because profit margins will decline, it is prudent to discount exceptional ones. Aside from the obvious fact that the market's price-earnings ratio during the past 20 years is 70% greater than it was over the previous 100 years, he will likely struggle to find anything else that isn't different. This is certainly not a round number like 15. The digits here are much larger. Over the past 2 decades, corporate profit margins in the United States have grown by a stunning 30%. That means you've undergone some major changes. You would assume there is if you read the newspaper or listen to the news, but there isn't if you run a correlation between the countries that do well and the personnel who work there. Past countries with rapid growth rates have underachieved to a small degree. Even though South Korea and China currently have the fastest growing economies in the world, this does not necessarily translate to higher stock market returns. Indeed, a modest negative link emerges when you plot them all together over the past century. Slower growing countries tend to fare slightly better in international trade. How profitable you are is more important than how quickly you grow to provide a return. Specifically, he believes that the rapid economic development in countries like China and India is an acceptable criterion of economic strength. Have you been able to lift any of your country's destitute into the middle class? How would you characterize the typical way of life? Where does one typically stand in terms of educational attainment? The Chinese deserve credit for this. The success the Chinese have had in educating their ordinary workforce should give us pause. They are not only 1/3 or 1/4 as expensive as the United States, but they are also more proficient in fundamental quantitative procedures, as seen by their latest test scores, which are greater than those of the United States. He believes capitalism outperforms other top-down economic systems in millions of ways. If it's long-term capitalism, it accomplishes one of 2 things poorly. Their discount rate makes 20-year events irrelevant, and Chinese solve them better. Climate change and population are the biggest threats today. Jeremy Grantham's main worry about American business and society is the rise of corporate power in politics and monopolies, and less to employees, unions, and differences in income, and is the 20th best century out of 20. Most unequal society, and how quickly you can move from one class to another. In this terrible time, why wouldn't workers be upset? But don't you think that capitalism is at its peak? It is the whole dominance when people from a certain industry are put in charge of the regulatory body that keeps drug companies and fossil fuel companies from hurting the public. They are owned by companies. These waves are a sign of a good society. You embrace capitalism. In 1880, worker capitalism was in charge of the 20th century. Then 2 wars and a depression happened. From 1945 to 1975, everyone gained from productivity. Pensions began. The workers made huge advisors. The average person's education got better, and the GDP was high. After 1985, the power of corporations grew steadily. When the dust settles, it's evident that these innovations benefited a small group of exceptionally talented people, who went on to start companies that would go on to amass tens of billions of dollars within a decade. And most workers don't even appear to care about them. Consider the consequences of Jeremy Grantham's presentation. Your feedback is welcome in the space provided below. We appreciate it a lot. For more videos on this topic, stay tuned.